In a New York Times op-ed that's out this morning, President Biden's former chief economist says that it's time to call the third bubble of our century the AI bubble. Joining us right now is Jared Bernstein. He served as the former President Biden's Council of Economic Advisors chairman. He's now a policy fellow at the Stanford Institute for Economic Policy Research. And Jared, thank you for joining us this morning. This is a big call. You think that what we're seeing right now officially is a bubble?
Well, my co-author Ryan Cummings and I, also from CEPR, think that that's the likely outcome. You know, the problem with bubbles is it's hard to know if they're really what you think they are until it's too late. But there are a number of characteristics: rapidly rising asset prices, which we sure have in AI, really some very extreme valuations, and if you look at things like, NVIDIA trading at roughly 55 times earnings, highly profitable companies, let's be clear about that. We point out that the share of the economy devoted to AI investment is nearly a third greater than the share of the economy devoted to internet-related investments back during the dot-com bubble. So we think there are enough analogies there to make the call.
As you mentioned, there are profits behind a number of these companies, the big ones. And we just had a chip analyst on a little bit ago, kind of told him about your thesis. He said he thinks we're still in the early stages of this. And part of that is because the ones who are spending the money on this are the biggest, most profitable and most successful companies in history. He thinks they're not stupid. When you see the likes of a Meta, a Microsoft, an Amazon, NVIDIA, all of these companies agreeing to put so much money into it, it does read differently than what we saw, let's say, back in 2001 with the internet bubble, when most of those companies had a lot of demand but no profits.
Right. Meta not equal to pets.com.
Right.
So I take your point, and I agree with many of the things that analyst said, but there are a couple of nuances that go in the other direction. First of all, you can have a bubble with completely profitable and technologically innovative firms investing into the bubble. What really defines the bubble is that the gap between the level of speculation, the level of investment, and credible, reasonable expectations of future profits is extremely wide. That's one of the things that defines a bubble. Another thing that defines a bubble is the extent of investment in the specific area we're talking about. So a lot of the profits of the companies that are in the Mag 7, not so much NVIDIA, because their chips really do feed right into AI, but Ryan pointed this out this morning in something he wrote. A lot of those profits are coming from other things. They're coming from ads and clouds and Amazon, which sells pretty much everything under the sun. If you actually look at the AI investments, they tend to be a small share of that. So that actually contributes to the bubble hypothesis.
Hey, Jared, people point to NVIDIA as being reasonable, and you use the trailing 12-month price to earnings. So in the last 3 years, excluding non-recurring items, the growth rate for EPS at NVIDIA is 88%. And even in the last year, it's almost 60%. So next year, I mean, obviously nobody knows, but it's not going to be 53 times earnings. It's probably closer to 30 times earnings. Yeah, and if it has a growth rate of above 50%, that's not that expensive. It's nothing close to what we were looking at in 1999, where it was infinity times earnings for a lot of those. And I'm not trying to be a fanboy for NVIDIA, but I'm just wondering which multiple we really use to get an accurate look at whether it's overvalued or not.
Right, it's a great point. You can only get so much in a 700-word op-ed, but the future oriented PE measures look different than the trailing ones. So
because it's growing so fast. I mean, it's crazy.
No, your point is well taken. Again, the thing that we're concerned about, we haven't even talked about this yet. It's actually, I think, one of the more sort of value adds piece in our op-ed, because the bubble conversation is pretty much ongoing. The thing we're concerned about is not so much that these companies, especially NVIDIA, can't defend their investments. It's the extent to which regular mom and pop investors are getting into this bubble in a way that's, should it pop, if it pops, we could have a really large negative wealth effect. We're talking hundreds of billions of dollars. This is the idea that, you gain $1 in stock market wealth, you spend an extra 3 cents. That's the wealth effect.
Right.
So what really took down the economy in the dot-com bubble was in part a wealth effect, which was actually quite small. Any contraction in GDP there was minimal. This is a lot bigger. So we're worried about the extent of investment relative to where we were back then, and the extent to which, should it pop, it will hurt consumer spending, which kind of feeds into some already underlying fragilities in the real economy.
That's a fair point. I guess the question is the fragility of any of this. If you saw, let's say, Meta bring down its CapEx spending by 25 or 50%, that would probably spook investors to a large extent. And by the way, Meta changed its name from Facebook to Meta based on where Mark Zuckerberg thought the metaverse was going to be at some point, and that has not turned out the way they thought.
Right. I mean, look, every day we're speculating in markets. So a bubble is hard to identify because it's a degree of speculation that goes well beyond the norm. And that's what we think we're seeing. I mean, when you have a share of the economy devoted to AI investment that at this point really surpasses what we saw with the dot-com, and when you see a level of profitability, not from the overall companies, but from AI itself, that's really quite minimal. OpenAI said they were going to need $1 trillion of investment this year, and their AI revenue is $13 billion. Now, again, Joe's point is well taken. You've got to account for future earnings. But to us and many others, that divergence between credibly plausible expected future earnings and this level of investment certainly looks bubbly.
All right. How about a lightning round? Is one of my favorite Biden administration Democrats. Are you ready?
I think so.
What do you think of the government shutdown to try and get health care?
It's the only leverage the Democrats have right now, and I think it's reasonable for them to be elevating the issue.
Oh boy, listen to you. But
what if some
crazy fiscal hawk on the Republican side said the only way to deal with $38 trillion is to shut the government down when Democrats are in power because they're spending too much money? Would you have said that was okay? You would not have said that. Okay.
I don't see any fiscal hawks on the Republican side.
Okay. You know what I'm saying. You know what I'm saying. You hated shutdowns. Okay, how about this? Have you endorsed Mamdani yet? Have you endorsed Mamdani yet in his brand of economics?
Those fiscal hawks on the Republican side, I call them chicken hawks. That is, they make the deficit look much worse, and then all of a sudden they become fiscal hawks.
You're avoiding the. Okay, how about who you backing for mayor of New York City, even though you don't live here?
Yeah, I leave that to the folks who live there. I think
punting again.
I think Mamdani is really impressive. I think his communication skills, his focus on affordability, I really like that. I think he's going to have some headaches trying to get his policies through Albany, but good for him for trying.